Think you're doing everything right by saving in a 529 plan? You might be losing thousands without even realizing it. From choosing the wrong investment options to missing out on key tax advantages, small mistakes can quietly eat away at your college fund. In this video, I'll walk you through the most common 529 pitfalls and how to fix them so your money actually works harder for your child's future. Avoid waiting too long to start contributing to a 529 plan. The biggest advantage of a 529 plan is tax-free growth, but that benefit depends heavily on time in the market. If you wait until your child is 10 years old to start saving, you are compressing your timeline into just 8 years before college, which dramatically reduces the power of compounding. For example, investing $300 a month starting at birth with a 6% annual return could grow to roughly $60,000 by age 18. But if you start at age 10, that same contribution might only reach about $35,000. That's a $25,000 difference just from starting late. On top of that, many states offer tax deductions or credits for contributions, but you miss out on years of those benefits if you delay. The practical takeaway is to start as early as possible, even if you can only contribute small amounts like $50 or $100 per month. Set up automatic contributions so you build consistency, and increase contributions over time as your income grows. Time is the most valuable asset in a 529 plan, and once it's gone, you cannot get it back. Avoid choosing overly aggressive or overly conservative investment options without considering the time horizon. A common mistake is either putting everything in stocks right before college or staying too conservative for too long. If your child is 2 years old, investing heavily in equities makes sense because you have 16 years to ride out market volatility. But if your child is 16, a market downturn could cut your balance right before you need the money. For example, if you have $80,000 invested aggressively and the market drops 20%, you suddenly lose $16,000 right before tuition is due. On the flip side, keeping everything in cash or bonds for 15 years may leave you with significantly less growth, potentially costing tens of thousands in missed returns. Most 529 plans offer age-based portfolios that automatically shift from aggressive to conservative as your child approaches college. These can be a good default option. If you manage investments yourself, gradually reduce risk, starting around middle school. The key is aligning your investment strategy with your timeline, so you maximize growth early while protecting funds later. Avoid using 529 funds for non-qualified expenses that trigger taxes and penalties. 529 plans offer tax-free withdrawals only when the money is used for qualified education expenses such as tuition, fees, books, and certain room and board costs. If you withdraw funds for non-qualified purposes, the earnings portion of that withdrawal is subject to ordinary income tax plus a 10% penalty. For example, if you withdraw $10,000 and $3,000 of that is earnings, you could owe income tax on that $3,000 plus a $300 penalty. Many people mistakenly assume they can use 529 funds for any college-related expense, but items like transportation, insurance, or extracurricular costs typically do not qualify. To avoid this, keep detailed records and match withdrawals to eligible expenses in the same tax year. Also, be mindful of timing, because taking a distribution in December but paying tuition in January can create a mismatch that triggers taxes. If your child doesn't use all the funds, consider changing the beneficiary to another family member or rolling a limited amount into a Roth IRA under current rules, rather than taking a penalized withdrawal. Avoid ignoring state-specific tax benefits and plan differences. Not all 529 plans are created equal, and many states offer valuable tax incentives that you can miss if you choose the wrong plan. For instance, some states allow you to deduct contributions from your state income tax, sometimes up to several $1,000s per year. If you contribute $5,000 annually and your state offers a 5% tax deduction, that's $250 in annual savings. Over 10 years, that's $2,500 you could lose by not using your home state's plan. However, some states allow you to invest in any plan and still claim the deduction, while others require you to use their specific plan. Fees and investment options also vary widely. One plan might charge 0.1% annually, while another charges 0.6%, which can eat into your returns over time. Before opening an account, check your state's tax rules, compare fees, and review investment options. A little research up front can lead to thousands of dollars in additional savings over the life of the account. Avoid overfunding a 529 plan without a strategy for excess funds. While it is great to save aggressively, putting too much into a 529 plan can backfire if the funds are not used for qualified education expenses. Excess funds withdrawn for non-qualified purposes will be subject to income tax and a 10% penalty on earnings. For example, if you end up with $20,000 in unused funds and $8,000 of that is earnings, you could owe taxes on $8,000 plus an $800 penalty. This often happens when a child receives scholarships, attends a less expensive school, or decides not to go to college. While there are ways to mitigate this, such as changing the beneficiary to a sibling or even yourself, or using funds for graduate school, it still requires planning. Recent rules also allow limited rollovers into a Roth IRA, but there are annual limits and lifetime caps to consider. A better approach is to estimate realistic education costs, adjust contributions over time, and diversify savings by also using taxable investment accounts. This gives you flexibility and helps ensure you are not locking too much money into a restricted account.